Valuations are a fact. This is what things are trading on at this point of time. They're never a catalyst. I see a lot of articles out there that, the Cape-Shiller P is so high, therefore the markets are going to correct. It never works like that. If that was the case, the market should have corrected last year and the year before last and the year before last, because actually markets have been valued pretty highly for the last 2 or 3 years. For me, what valuations tell me is that, yes, on an absolute basis, markets are expensive, and therefore the margin of safety of investing at this point of time is lower because you've had a very strong run in markets for the last 9 or 10 years. So you need to be a little bit more cautious. You need to be vigilant with your portfolios. So that's point number one. Point number two is that if you look at valuations on a relative basis, then versus fixed income markets, equities are still the best house in a bad neighborhood. So equities would still be the way that you would look to invest and grow your capital over a longer term time frame. The last point I'd make on valuations in general is, the construct of the global equity markets have changed. If you look at companies today like the Facebooks and the Googles and the Amazons of the world, they're a lot less asset heavy than the companies of the past like Exxon or GE. And so a lot of our valuation constructs, which are looking at companies over a very long cycle, don't take these changes of how much technology has become as a bigger part of the market, for example, into account. So averages, in my view, don't always tell you the whole picture, and you need to go a little bit deeper to really figure out which is valued and which is overvalued. A doomsday scenario, it really depends on your time horizons and what you're going for. I think if you look at the world, there are some themes which will continue irrespective of what happens to the economies on a shorter term basis. Aging, demographics, the growth in emerging markets, the growth in new renewable technologies, the impact of technology on various industries are some of the things which are going to stay with us. And companies which can manage the downturn better than their peers are the ones which will come out of it stronger. So the work that you have to do is, at this point of time, identify the management teams, identify the industries that you think are industries of the future, identify the management teams in those industries who have the vision to navigate a recession and navigate a hard landing as you lay out, and invest with them through the cycle, because they will come out much stronger. They'll be the companies which will be the best of breed and which will make money for investors on the other side. That's what I'm focused on.